Let's talk about something that might sound a bit boring, but is super important. Interest rates and tax deductions. You know, the higher the interest rate, the bigger the tax break you could get. And that's pretty cool, right? So here's the deal. If you're a homeowner and you decide to itemize your tax deductions, you can actually deduct the interest on your mortgage. And we're talking about a pretty significant amount, up to $750,000 of your mortgage balance. This is especially helpful if you're buying, building, or improving your home. Now you might be thinking, but wait, in the last few years, this didn't seem like such a big deal. And you're right. With lower interest rates, many of you didn't see a huge benefit because your total interest expenses were often less than your standard deduction. But here's the twist. Interest rates have gone up. Based on the latest info from Freddie Mac's weekly survey, they've practically doubled. Let's break it down with an example. Imagine you have a $500,000 mortgage at 7% interest rate. Your annual interest expense would be a whopping $35,000. That's way above the standard deduction, which means you're more likely to itemize and take advantage of that sweet mortgage interest deduction. I bet you're wondering, how big is the tax benefit? Well, let's take a look. Express your tax bracket as a decimal. 24% equals 0.24. Then subtract that number from the whole number 1. 1 minus 0.24 equals 0.76. Now multiply that number by your interest rate. 7% times 0.76 equals 5.32%. In this example, a 7% mortgage costs 5.32% after tax for someone in a 24% tax bracket. So while higher interest rates might seem like a bummer at first, they could actually play in your favor come tax time. Keep this in mind as you navigate your home buying journey. And remember, I'm here to help you every step of the way.